Good morning, everyone. Thank you for attending the webinar. We're very excited to present this to you. We're going to give it another minute or two for those who are delayed to get in because we know it's trucking and sometimes things just get in the way. So we'll give it a minute or two and we're going to get going. This is going to be a very informationally packed webinar. There's a chance we won't get to all of your questions because there's so much to talk about. But we want to respect your time and our presenters' time and try to limit this to half an hour. But we'll 30, 45 seconds or so and we'll get going. We hope you're having a great day and decent weather wherever you are and no state on fire or flooded. All right, let's begin the webinar. Thank you for attending. My name is Mike from Superior Trucking Payroll Service, and today's webinar is why tax planning for trucking companies is crucial in an uncertain market. Our guest speaker today is Troy Hogan, and we're going to talk about him in a minute, but first we're going to do just a little bit of housekeeping here. How to use GoToWebinar for those who are uninitiated. All of your lines have been muted for the entirety of the webinar. There should be a question box up in the little GoToWebinar window. If you have any questions, type them in there anytime. Even if we can't answer them during this webinar, we'll hopefully still be able to get you some kind of answer at another point later. You can slide the GoToWebinar close by hitting the double arrow or the orange arrow, but don't click that black X. That's going to check you out of here. So you could always get back in, but you might miss something really good. A little bit about Superior Trucking Payroll Service. I'm going to keep this brief because we do have some time constraints. We are a payroll service built for trucking. Our mission for our company is to help trucking families, which are the owners' families, the office people's families, the drivers' families. That's why we do webinars like this. You can read all this stuff later. I want to keep going so that we can get to Troy. This is a little bit about KSM CPA, or Troy's company, the Transportation Services Group. They have a lot of clients. They do a lot of great things for trucking companies. You don't want to just have anybody doing these things for you. You want somebody who understands trucking to do them. And if you know what these things are, then you know why they're important and why you should talk to somebody who can really help you with these things, again, especially in trucking. There's too many for me to list here, but there, as you look at them, I'm sure there's something that jumps out to you that's definitely worthwhile. Let me introduce our speaker, Troy Hogan. He's a director with KSM's Transportation Services Group. He's a trucking CPA guy. He knows all these things about trucking. He talks about, even in here, about per diem and fuel tax credits and entity restructuring. All these things with a trucking emphasis, which again, I can't stress enough that you really want trucking experts doing these kinds of things for you, and Troy's your guy. So without further ado, let me introduce Troy and we'll get started with today's webinar.
All right, Mike, thank you very much, and good afternoon, good morning, America, whatever time zone you're in. I need to apologize up front. So I got a late start in life, folks. So I have a 6-year-old, and he just started kindergarten a few weeks ago. And even with all the masks and the social distancing, he still couldn't stop the common cold from coming into our house. So if you lose me for a second, it's probably because I muted myself. Take a drink of water or something. So bear with me. We got a lot to cover today. First up, I want to talk about tax planning, especially in this COVID environment. Then just depending on how much time we have, we're going to talk about the CARES Act and some of the income tax provisions that are in there. And honestly, we may not get to all those topics, but you will be provided the slide decks, and we could always have a conversation offline if you have specific questions. And I do want to leave time for some Q&A. So with that, let's get to work. So I want to open up with a story here. This is a real story, not made up at all, but I will note it is not a Cat Sapper and Miller client. It's a story I heard out on the road, and this is with a trucking company down in the southern part of the U.S., and their CPA calls up the owner on April 15th, on the deadline, folks, and says, "Hey, Joe, I'm sorry to drop this on you, but we just worked up your extension for your trucking company, and you personally owe $1 million, and it's due today." And so the trucking owner, probably had a few choice words, got out his checkbook, wrote the $1 million check, took it to the post office, went to lunch. Gets back from lunch, and again, I'm not making this up. He gets back from lunch, and there's a voicemail from his CPA that says, "Hey, we made a mistake with your extension. You really don't owe $1 million. Instead, you're getting a refund." And he dropped the phone, raced down to the post office, and spent the rest of the afternoon trying to look for his outgoing check of $1 million, because everyone knows once you give the IRS money, it's like pulling teeth to get it back. Folks, this is 100% preventable. It does not have to happen to you. And that is through careful tax planning in the fall. So let me tell you a little bit about sort of the process that the Cat Sapper Miller Transportation Group does with regards to tax planning. So the prime time tax planning is, like I said, in the fall. So think September, October, November. I'm getting a lot of calls, this week wanting to get a jump start on projections. But sometimes, for some clients and some circumstances, we do two sets of tax projections, one in July, sort of a 6-month view, and then we'll update it in the fall. Again, it just depends on the year. And some of the things we do during this process, number one, for an asset-based carrier, depreciation is the biggest cause of tax joy or tax heartache, depending on the year. So we're definitely updating depreciation schedules, taking a look, seeing if it makes sense to purchase more equipment before year end. We're also reviewing equipment sales, because a lot of the times for your internal books, you're not fully depreciating your equipment down to zero. So maybe there's not a lot of gain on equipment sales on your internal books, but for tax, you fully depreciated that equipment. And so there's a lot of gain that's off the balance sheet. So off the income statement. So we want to take a look at that. A lot of our trucking clients enjoy being on the cash method of accounting for tax purposes. However, that amount of deferral can fluctuate depending on the year. So we want to get that accounted for in our tax projection process. We're also looking at shareholder distributions for S Corporation trucking companies. A lot of my S Corps live in what I call suspended loss land, which means there's a lot of loss carry forward. That's great, but what that means is when the owner wants to take out money to buy something personal, that amount could be taxable, or maybe it needs to become a shareholder receivable. And also on along the same topic, we take a look at the shareholder loans. If the shareholder has loaned money into the company, that's great, because when you loan the money into the company, you can use that to deduct losses. However, when it's repaid, there's the potential that repayment of the loan is taxable. These are all things we just don't want to be caught off guard with at the end of the year. Finally, we take a look at if there's any entity restructuring or tax elections or acquisitions that happened. Just want to make sure we have all our ducks in a row come year-end time. Let's take a step back, though. Why in the world do we need to do tax planning on a year-over-year basis? It's because every company, virtually every company, has a deferred tax liability. Well, what is that? Well, that's every year. My definition of it It's the kicking the can down the road liability. So every year that you have a GAAP income statement that, let's say it has $1 million of GAAP profit, but you didn't pay anything to Uncle Sam. Well, if the tax rate applied to that $1 million we just used is sort of your deferred tax liability that one day will come to roost. Now, if you're a C corporation and you have audited financial statements or reviewed financial statements, your accountant should be putting that deferred income tax liability on your balance sheet. So it's insight, and so you kind of know what that number is. However, like most of us, I presume, we're either an S corporation or a partnership, and that liability is not on our balance sheet. In fact, it's a shareholder liability. And when you have an asset-intensive business, like an asset-based carrier, it's really important to be aware and monitor your deferred tax liability. You don't really need to lose sleep on it, but we need to plan for it. Not only how it's going to reverse here in 2020, but you kind of want to take a long-term look at it as well. Do a 5-year map out of how this could reverse depending on how much equipment you buy on any given year. So what are some common deferred tax items? Like we said, the most important, the biggest, is the book versus tax depreciation. For GAAP, you're depreciating trucks over 5 years, trailers over 7 years, and you're probably using a salvage value of 10, 15, 20% because that equipment's always worth something. Now on the tax side of things, I'm just writing that stuff off, in the year you purchase it, probably year one with bonus depreciation. That's a big source of a deferred tax surprise. Like we said, a lot of GAAP financial statements are on the accrual method, and a lot of tax returns for trucking companies are on the cash method. So that's a deferred tax liability that we need to account for. Again, with goodwill, this can be a deferred tax liability, or it could be what they call a deferred tax asset. For books, you are, and I'm not 100% sure what the current GAAP rule is, but what I think it is you can either keep that goodwill on your books or elect to amortize it over 10 years, whereas for tax purposes, we're amortizing that over 15 years regardless. For an accrual basis taxpayer or a cash basis taxpayer, an allowance for bad debt is not deductible until it's actually written off, so that's a deferred tax asset. Then there's some expenses, some certain accrued expenses, some certain reserves, insurance reserves, loss reserves, etc., that are not deductible until the loss is actually realized. And there's net operating losses. That's a deferred tax asset. The 163J limitation, that is the interest expense limitation. That could be a deferred tax asset. And finally, state bonus adjustments, while it may be immaterial, that is a deferred tax asset that could offset the GAAP versus tax deferred tax liability on depreciation. I threw this slide in here. We're not going to talk too much about it. And I normally bring this out when a company comes to me and wants me to calculate sort of if they're going to sell, they want me to calculate an after-tax cash flow analysis. But I threw it in here because it just goes to prove, folks, that you may be looking at your internal financial statements, and you may see that you have, in this example, $4 million of asset value. But if you convert that to the tax value, because maybe you're on the cash method of accounting, so there's no value in the receivables, and you're expensing equipment, so there's not as much value in the equipment. Bottom line is, on the tax basis, there's a lot of gain that's sitting out there that you need to be aware of. And again, it's the deferred tax liability. Oh, did we skip the slide? Nope, sorry.
No worries.
So year over year, we've kind of talked about this. On a year over year basis, what triggers recognition of this deferred taxes? Well, the biggest thing I've seen this year is not purchasing enough equipment during the year. That's going to cause your book tax depreciation to reverse. and cause a lot of heartache at tax time if you're not prepared for it. Again, depending on what sector of the industry you're in, you might be having a good year or you might not be. And if you're on the cash method, your receivables may have shrunk, and maybe you're stretching your vendors so your payables have increased, which means your cash method deferral, you may have to give some of that back here in 2020, which is going to increase your taxable income. The ultimate trigger of recognizing deferred taxes if you sell the assets of your business. That will cause the reversal of all the kicking the can down the road. However, you could sell your stock of your business. Then if you sell the stock and there's not a 338H10 election, which says even if you sell your stock, we're going to treat it like an asset sale. You could sell your stock and the buyer inherits your deferred tax liability, but they're probably going to want to lower the purchase price as a result of that. So let's walk through an example. Now, I got to tell you, folks, what I'm seeing so far is concerning here in 2020 with tax planning. And this year more than ever, what your internal financial statements show may not be what you actually pay tax on. For example, like we said, how much equipment have you really purchased this year? There could be a big book tax difference on depreciation, and you want to know that today so that there's still time to buy equipment if you want to. Receivables are down. This accrual to cash deferral is reversing this year from what I'm seeing. Here's a big one. Did you get one of the paycheck protection loans? Because right now, and I don't think this was the intent of the program, but right now the IRS got a hold of that and they're saying, okay, well, if you got a $400,000 paycheck loan, when it's forgiven, it's not going to be taxable. However, we're not going to let you deduct the payroll and other expenses you paid with that. So in a roundabout way, it is taxable. And that needs to be accounted for in tax projections. But there's a lot of questions. Again, we're still waiting for guidance on IRS to change their mind. And I think there's bipartisan support on that. And also, we don't know if these loans are going to be forgiven in 2020 or 2021. And regardless of that, we don't know if the expenses are disallowed. What year will they be disallowed? So a lot of questions. Stay tuned for that. We need answers yesterday. There's a lot other things I'm seeing this year. A lot of trucking companies, I told you they have loss carry forwards, but we're coming off a couple of good years and those loss carry forwards are dwindling. So it's a good time to check what is the balance of loss carry forwards you have coming into 2020. Now let me walk you through an example. And this is admittedly something I created myself. It's a worst case example, but I'm seeing versions of this with my client base right now. Let's say you have a book loss of $500,000 and you bought some equipment, but you didn't buy a lot and you didn't buy near as much as you have in other years, maybe based on your trade cycles. So maybe your book depreciation $6 million and your tax depreciation is only $3.5 million. So when you're calculating your taxes, you're going to have to add back $2.5 million of income from that difference alone. Then you sold some equipment. I told you that your tax gain is higher than your book gain, most likely, so there's a pickup there. This company's on the cash method of accounting. The deferral has shrunk, which means income pickup. Meals are, as always, only 50% deductible. Per diem is 20% non-deductible, so there's an adjustment there. Entertainment, for the past couple of years, has been 0% deductible. Oh, and then there's the disallowed paycheck protection loan expenses of $1.5 million in this example. So folks, this is how you can turn a $500,000 book loss into a $4 million taxable income. And it's very possible. And sort of some of them, if you're in this situation, the next questions are, what kind of loss carry forwards do I have? And then, does it make sense to buy more equipment and help kick this can down the road another year? So we have about 10 minutes left. I want to leave about 5 for questions and answers. So let's go to the next slide. I'm sure everyone's aware of the stimulus, officially known as the 2020 Recovery Rebate for Individuals. It's where you got checks during the year of $1,200 if you're single, $2,400 if you're married, $500 for each kiddo. You didn't get these checks. Well, first, the IRS looked at your 2019 tax return to see if your income was more or less than $199,000. If you didn't file your 19 return, they used your 18 return. And if you didn't have an 18 return, then they went to Social Security records, and that's how you read about deceased people getting checks mailed to them. But the interesting thing is that all this is going to be reconciled on the 2020 tax return. So let's say you didn't get a check because your 2019 or 18 income was above 200. Let's say 2020 comes around, and because of COVID, business losses, etc., you're under that, you're going to get your stimulus at that time. The interesting thing, though, is let's say you got a check based on 19 income being below the threshold, but then you get to 2020 and you actually have taxable income because of everything we talked about. And is the IRS going to make you repay the stimulus at that time? I don't think they are. I don't know one way or another, but stay tuned for more info on that. Let me talk about a couple of things real quick. Amended return opportunities as a result of the CARES Act. First off is for qualified improvement property, which is basically construction that you've done to the interior portion of a non-residential building, so your office. If you did this kind of construction in 2018, check your depreciation records and tax returns, because if you depreciated that using a 39-year life, which was the law, now they've come out and said, okay, it should have had a 15-year life and be eligible for 100% expensing in the year you placed it in service. So there could be an opportunity to amend your tax return and accelerate those deductions. Well worth looking into if you spent significant money in that area. Next slide. Next slide. Next slide. Next slide. Net operating losses. So this is another big one for amended return opportunities. So you used to be able to carry net operating losses back 5 years and forward 20. However, President Trump and his Trump tax reform plan, they took away the ability to carry back net operating losses and said you could only carry them forward. Now, surprise, with the CARES Act, you can yet again carry back a net operating loss 5 years. Now, if you're a C corporation, this could be a windfall, because if you carry that net operating loss forward, the tax rate's 21%. So $1 million deduction is worth $210,000. However, if you're eligible to carry it back to 2013 or 14, when the tax rate was up to 35%, well, suddenly that net operating loss just got a lot more valuable. So you definitely need to check into that if you're in that situation. There's also an amended return opportunity if you got caught up in the Section 461 overall loss limitations in 2018. Basically, it's, again, part of the Trump tax reform that said if you have a deductible loss that's in excess of a threshold amount, and for married filing jointly, it was $500,000 in 2018. If you got caught up in that, the CARES Act's basically saying we're going to suspend this rule for a couple of years. So go ahead and amend your return and claim those losses. So you need to check and see if that applies to you, see if it makes sense to amend your return, which it probably does. Next slide, please. Let's talk about this real quick. If you are over $25 million in gross receipts, you are subject to the 163J interest expense limitation rules. And what it basically says is if you have interest expense in excess of 30% of your adjusted taxable income, which right now is EBITDA, then that interest expense is going to be disallowed. Well, the CARES Act just changed the 30% to 50%. So it's possible you could sorry, I'm going to take that back. So CARES Act changed to 50%. So you need to watch out for that on your 2019 returns. And then that only applies to corporations and S corporations. It doesn't apply to partnerships. To make a complicated rule even more complicated, they get their own set of rules, which says in 2020, 50% of the interest will just free up at the individual level and then be fully deductible. With my 1 minute left, I want to bring up a tax planning point with regards to that 163J. And in a couple of years, I think it's in 2022, I said EBITDA. In 2022, that changes to EBIT. You'll no longer be able to add back depreciation or amortization when you calculate this, which means my asset-based trucking companies may get caught up in this limitation. And one planning point we're looking into around that is to consider maybe not only a mix of straight up standard purchases of equipment, but you might want to consider doing some track leases, which are treated as operating leases for tax purposes and have no interest expense component, therefore nothing to get caught up in this limitation. Next slide. So we've talked about a lot today, an overwhelming amount, and if anyone has any questions, please feel free to reach out. There's a lot of programs that are available right now, folks, an unprecedented amount. Could you go back to that last slide, please?
Yeah.
A lot of programs. There's an employee retention credit, and it's only available to people that didn't get a paycheck loan. You should be aware you can defer your employer payroll taxes. So anyone that wants to be in debt to the IRS can now do so. There's also this Family First Coronavirus Response Act. It's kind of a legal issue, but it has to do with payroll credits for paid sick leave. It's kind of like FMLA. And there are a ton of state and local programs and grants that are out there just waiting to be taken advantage of. And with that, I will turn it over for Q&A.
Awesome. Thank you so much, Troy. There's so much information in there. It's great to have, and we appreciate you sharing that with our group. One question, and I'm going to rephrase some of these. What if you had a crystal ball, do you think that the PPP forgiveness will ultimately end up being a taxable event, either through the reduction of expense or through the repayment of the loan being income, or however you want to say it? Or do you not even want to guess because it's 2020 and every guess has been wrong? That's my own part.
Yeah, I wish I wish I knew. Like I said, I don't think it was the intent for it to be taxable, and I've read that there's bipartisan support that it should not be taxable. So I think we need to, unfortunately, just wait it out to figure this out, and it probably has to do with how the election turns out, whether or not it's going to be taxable or not. I mean, I don't know. I really don't.
Okay. Yeah, it's certainly a crazy year. One of the slides that we went over really quick was the student loan. You can pay an employee student loan down, and it's deductible for you and not taxable for them. Are the mechanics of that really complicated, or can you just write a check out to their student loan servicing people?
Yeah, that is a great program because not only do we have a COVID crisis, but we have a student loan crisis. It's ridiculous. And this program allows companies to, pay up to $5,250, I think, of an employee student loan, and the employee doesn't have to pick it up. It's a great program. And I don't know if I know the details of it off the cuff, but I think it might be as easy as the employer writing the check directly to the student loan company, Sally Mae, if you will.
Awesome. Yeah, that'd be great. Anytime you can get deduction on the employer side and not have income on the employee side is always a win. So at least
it's a great benefit.
Look at it. I'm going to wind back one slide. Just add really quick that on our website at truckingpayroll.com/tips, we did an FFCRA webinar, and we did talk about through some of the CARES Act things, including the deferral of employer taxes. You can go to truckingpayroll.com/tips, and you can find all those there. You don't have to register or anything. They're just there waiting for you. One of the questions we already get, you answered a bunch of the questions as you were going, which is great. We are going to be sending out slides of the webinar to everybody. You've got Troy's contact information on this page. If you need further follow-up and to see what he can do for you. They have a great website, KSM/CPA/transportation, a lot of resources there. And then their LinkedIn page I put on there too. You should go follow them. There is a longer version of this webinar. I asked him to cut it down because I try to keep him to half an hour. He's got a longer version that he's presenting. I think it's next week at the McLeod User Conference. So if you're a McLeod user, you can hear some of these things in more detail, which I think will be great. It's because, again, I mean, tax is so, I know it's not the most exciting thing to talk about. We're not talking about like astronauts or something, but it's so important. Like he showed you with the deferred tax liability, my goodness, you can lose money and pay taxes. So it's not a good situation. And as you can see there too, you've got our truckingpayrolls.com/tips and our LinkedIn page and Facebook page. For those of you who haven't done it already, if you could go to that YouTube page and subscribe. If we get to 100 subscribers, we don't have to have that goofy end of the YouTube page. Then it can be like channel/STPS or something like that. So, but I need about 45 more people to do that. If you ever are looking at it there, please subscribe. And also save the date. We're going to do our per diem best practices webinar on October 13. We will invite all of you to come and list, and we'll talk about per diem and how Troy had mentioned it as well, about how it can save your company money and save your drivers money. It's a win everywhere. We look forward to showing you that. If you have any more questions, type them in to the question box here or email it to either of the addresses, or just reply back when we send you the slides. I'll send you the slides, or Brandon will tomorrow, one of us will, and we'll send you a link to this on YouTube so you can go watch it again if you need to. And if you've got any other questions to follow up, you feel free to reach out. We're here to help, and I mean, KSM, that's what they do too. They're here to help. So just reach out to us, and hopefully we can get you pointed in the right direction. Thank you so much to Troy for being willing to do this. We hope your cold that you inherited from the first week of school goes away soon, and we're thankful it's not COVID. And yeah, these are some more things about KSM and all the other industries that they also help. I mean, transportation, of course, is the best one. We'll just highlight that one for you because that's the one that we care about. But yeah, awesome company. They're a good sized CPA firm, and they've got the reach to help you with all these things. And like I said, they're transportation experts, which is where Troy's group is from. So that's awesome. If you need anything else, anybody, let us know. And like I said, we'll be sending out the slides. We'll send out the link to watch it on YouTube. And thanks for coming, and have a great day.
Thank you, Mike. Thank you, everyone.
All right, thanks, Troy. Talk to you later.